Earlier in this session, we introduced the concept of credit events in the context of a CDS. Let us now understand these credit events in more details. There are credit events that can lead to default of reference obligation. It starts with failure to pay any cash benefits to the investor, which then escalates to the reference entity filing for bankruptcy or undergoing corporate restructuring, and finally into moratorium. Let's understand these events in details. Failure to pay includes the failure by a reference entity to make, when and where due, any payments as part of the financial security. It will include a grace period specified in CDS agreement. One of the major examples of failure to pay is AIG. American International Group, also known as AIG, is an American multinational insurance corporation which deals with multiple insurance products but also focuses on global capital market operation and direct investments. It insured derivatives worth tens of billions of dollars against default but did not purchase reinsurance to hedge that risk. Secondly, it used collateral on deposit to buy mortgage-backed securities. When losses hit the mortgage market in 2007-2008, AIG had to pay out insurance claims and also replace the losses in its collateral accounts. AIG faced the most difficult financial crisis in its history when a series of events unfolded in late 2008. The insurer had sold credit protection through its London unit in form of credit default swaps on collateralized debt obligation when they had declined in value. It had insured $441 billion worth of CDS, leading to a liquidity crisis that began on September 16, 2008 and essentially bankrupted all of AIG. The United States Federal Reserve Bank stepped in, announcing the creation of a secured credit facility of up to $85 billion to prevent the company's collapse, enabling AIG to deliver additional collateral to its credit default swap trading partners. Moving on to bankruptcy. Bankruptcy refers to a situation where a reference entity is dissolved or becomes insolvent or unable to pay its debt, has passed a resolution for its winding up or liquidation, becomes subject to the appointment of an administrator or provisional liquidator, or has a secured party take possession of all or substantially all its assets, or has a distress sale. One of the best examples of bankruptcy is Lehman Brothers. On September 15, 2008, Lehman Brothers filed for bankruptcy with $639 billion in assets and $619 billion in debt. Lehman Brothers bankruptcy filing was the largest event in history. Lehman was the fourth largest US investment bank at the time of its collapse. Lehman's fall also made it the largest victim of the subprime mortgage-induced financial crisis that swept through global financial markets in 2008. Lehman's collapse intensified the 2008 crisis and contributed to the erosion of close to $10 trillion in market capitalization. It filed for bankruptcy on September 15, 2008, and the impact of that is still seen. The caption "Weak, they changed the decade" applies aptly to the impact Lehman's downfall created in the market. Next, we move on to restructuring. Restructuring refers to the situation where a reduction in the rate or amount of interest payable, a reduction in amount of principal or premium payable at maturity, a postponement or other deferral of a date or for either payment or interest or principal, or a change in ranking in priority of payment. CMEX is one of the most popular examples of restructuring. After having problems with the Mexican peso devaluation of 2008, including problems with derivatives, CMAX had to rethink its international standings to decrease debt and avoid a default. On 13 December 2011, an agreement was reached, with CMAX receiving $600 million in compensation as a bailout plan on and benefiting from the cancellation of $154 million in debt. CMAX has now said that it had completed its $7.2 billion debt restructuring plan, and Fitch has given a positive outlook on future of CMAX. Now the question is, why is restructuring difficult? Restructuring is a soft credit event that is the loss to owner of reference securities is not always obvious. Post restructuring, debt will often have a variety of maturities. This means that cheapest to deliver or CTD option may be valuable. The cheapest to deliver security is relevant only for contracts which provide a variety of slightly different security may be delivered. This is common in treasury bond futures contracts, which typically specify that any treasury bond can be delivered so as long as it is within a certain maturity range and has a certain coupon rate. However, in bankruptcy or default debt is accelerated, outstanding debt becomes relatively homogeneous and CTD option has little value. Here, would also like to talk about Greece debt restructuring. As per economists who have examined some 800 financial crises had mentioned that Greece since its independence has defaulted 4 times on its debt and currently having $38 billion even after receiving various bailout packages. Finally, we come to the last credit event, moratorium. A moratorium period is a time during the loan term when the borrower is not required to make any repayment. It is a waiting period before which repayment by the way of EMIs begin. Normally, the repayment begins after the loan is disbursed and payments have to be made each month. An example of moratorium is KASP Bank. The federal government, on the application of State Bank of Pakistan and an exercise of powers conferred upon it under the Banking Companies Ordinance 1962, had placed KASB Bank Limited under moratorium for a period of 6 months. This was done in order to protect the interest of depositors or the other stakeholders and due to financial health and other circumstances which were faced by KASP Bank Limited. Consequently, the payment of certain debts and obligations from the bank would be suspended while it would continue to receive all payment or recovers that were due to the bank. The federal government had directed the State Bank of Pakistan to consider restructuring or amalgamation of the bank as per the provisions of the Banking Companies Ordinance 1962. Finally, we come to the CDS indices. A credit default swap index is a credit derivative used to hedge credit risk or to take a position on a basket of credit entities. This is a portfolio of actively traded liquid names in a particular sector of the market. They are tradable products that allow investors to establish long or short credit risk positions in specific credit markets or market segments. Like S&P 500 or other market benches, the credit default swap indices reflect the performance of a market basket of assets, namely a basket of single name credit default swaps, that is the credit default swaps on individual credits. A CDS index is a completely standardized credit security and may therefore be more liquid and trade at a smaller bid offer spread than its single name components. There are two main families of CDS indices, the CDX indices and the iTraxx indices, which are the most popular indices that trade credit default swaps. The CDX indices contain North America and emerging market companies and are administered by CDX indices company known as CDS Index Co. and marketed by Market Group Limited. The iTrack indices contain companies from rest of the world, specifically markets in Europe, Asia and Australia that trade in credit derivatives. They are managed by the International Index Company, also called the IIC, which is owned by Market. The screen shows the different CDX indices with the number of entities traded. The CDX indices are broken out between investment grade IG, high yield HY, high volatility HVOL, crossover XO, and emerging market EM. For example, the CDX.NA.HY is an index based on a basket of North America NA single name high yield CDS. Similarly, on this screen you can see the different iTrax indices with number of entities which are traded. In addition to CDX and iTrax, there are many other CDS indices in the world. The first type is ABX or ABCDs, which is based on asset-backed securities. Second, we have CMBX, which is based on mortgage-backed securities. Next we see is LCDX, which is based on syndicated secured leverage loans of 100 companies. After LCDX, we have LevX, which is based on European leveraged loan CDS. Finally, we have MCDs, that is based on municipal bonds. CDS indices allow capital or credit exposure constrained businesses, banks for example, to free up capacity to facilitate doing more business as they can earn premiums by selling CDS indices. Firstly, CDS indices can be short credit positioning vehicle. It is easier to buy a credit protection than short bonds. Secondly, we have trading. CDS indices can be traded and priced more easily than a basket of cash bond indices. Next is liquidity. CDS indices are highly liquid instrument which are thereby ensure tighter pricing and easy marketability. And lastly, CDS indices are more transparent. The features, rules, regulations, prices are publicly available in market, thereby ensuring greater transparency. Continuing on with the benefits of CDS indices versus trading single name CDS. Investors take a view on deterioration or improvement of credit quality of a reference credit. Investors can tailor their credit exposure to maturity requirement as well as desired seniority in capital structure. CDS offer the opportunity to take a view purely on credit. CDS indices allow the investors to invest in foreign credits without bearing unwanted currency risk. CDS indices require no capital outlay and therefore it creates leverage. So who are the participants in a CDS index? The first is market. Market owns and operates the indices, including licensing, marketing, administration and calculation. A market publishes prices daily on its website. Next are banks. They trade indices on behalf of their clients, act as market maker. They are intimately involved in the indices, actively participating in roles and playing a key part in product development. We also have institutional investors. They take positions as hedgers to protect their bond portfolio or as to speculate. Next is ISDA. Market and banks have worked with ISDA to create globally approved legal documentation for CDS, LCDX, iTrax and LevX indices. And lastly, we have third-party firms. Third parties have made trading credit indices easier by integrated them into their platforms. CDX role is basically a process that includes reconsidering the current constituents of the indices and issuing new indices with revised or updates constituents. The main reason for this to keep the index in line with the market tradability and ensure sufficient demand and supply. By using the most liquid entities in single name CDS markets over the previous 6 months, market ensures that the indices are an accurate reflection of the credit index market and ensure liquidity for all market participants. Let us now learn about the valuation of pricing of CDX. An index launches with a price of 100% on September 20, post a roll with a fixed coupon of 60 basis point. A client buys the CDX for $25 million on December 10 for a price of 95% and a spread of 80 basis point. The spread, as you will recall, is the annual amount of protection buyer must pay the protection seller over the length in the contract and is expressed as a percentage of notional amount. How the CDX would be priced? Client A will have to make an upfront payment of $25 million into 100 minus 95, that is 5, divided by 100, which is equal to $1.25 million. He will also receive an accrued interest payment as he will have to make a full premium payment on the 20th. The accrued interest payment would be $25 million into 6% into 10 plus 31 plus 30 plus 10 divided by 360, which is equal to $3,37,500. The net payable amount will be $1.25 million minus $3,37,500, which makes it $9,12,500. The concept of accrued interest here makes it easier for operations as all participants will pay the same amount of coupons on the premium pay date rather than some pay full while others pay partially. On December 20th, client A will pay the below fixed coupon, that is $25 million into 10 plus 31 plus 30 plus 20 divided by 360 into 6 divided by 100, which equals to $3,79,166.67. Client A then decides to choose his position on Feb 27 when the spread is 110 basis point and the price is 95.80%. He will receive $25 million into 100 minus 95.8 divided by 100, which equals to $1,05,000. He will pay an accrued interest of $25 million into 6 divided by 100 into 69 divided by 360, which gives us $2,87,500. This gives him a net receipt of $1.5 million minus $2,87,500, which equals to $7,62,500. That's it for now. This completes this topic on CDS, where you learned about credit default swap, credit events, and CDS indices. We hope you found the session insightful. Thank you.